Hello, good day everyone. How are you doing? I believe you are living your best life. I wish you success in everything you do. I'm Mama Duko, and today's tutorial video I will be discussing about debit and credit in accounting. And also I will be giving you rules in debit and credit, and also an illustration for us to analyze. So our lesson objective for today is analyze common business transactions using the rules of debit and credit. Every business transaction which can be measured in monetary terms finds a place in the accounting transactions of the firm. And in order to record such transactions, a system of debit and credit has been devised, which records such events through two different accounts. And we have discussed in our former videos that account is the record of all the movements in a particular item of assets, liabilities, or equities during a period. And the basic visual representation of an account is the T account. Okay, so the T account resembles the capital letter T. The left side contains all the debits to the account, while the right contains all the credits to the account. And what is debit? A debit is an accounting entry that either increases an asset or expense account or decrease a liability or equity account. It is positioned on the left in accounting entry. And what is credit? Credit is an accounting entry that increases either a liability or equity account or decrease an asset or expense account. It is positioned on the right in an accounting entry. And take note, a minimum of 2 accounts is always impacted, with a debit entry recorded against one account and a credit entry being recorded against another account. And there is no limit to the number of accounts involved in transactions, but the minimum cannot be less than 2 accounts. The totals of the debits and credits for any transaction must be equal to each other to be accurate. And this is what we call the double entry accounting system. I have here the general journal, which shows the column for the debit side, which is the left side, and the column for the credit, which is on the right side. So this is how it will look on the bookkeeping record. As I have said, the modern bookkeeping method is the double entry system. It has a debit and a credit entry showing respectively the value received and the value parted with. Business transactions and events are recorded initially in a journal and finally in a ledger. So this will be discussed in our coming videos. Proficiency in the recording process is measured by the proper application of the rules of debit and credit. So I will give you the golden rules of debit and credit. I have here the golden rules of debit and credit. First, debit what comes in and credit what goes out. Second, debit all expenses and losses and credit all incomes and gains. Third, debit the receiver and credit the giver. I have here a diagram showing the asset, expense, and dividend accounts. I will show you using the rule of debits and credits on how these accounts be positioned. Is it be on the debit side or the credit side? Okay, so according to the first rule of debit and credit, debit what comes in. So assets. So increase in assets are recorded as debits. Okay, so any increase in assets, okay, be recorded as debit. Okay, example of assets, cash. Okay, so the cash that will flow to the business entity or the cash inflow. Okay, and another example, the new equipment that are added for the use of the business operations, the account receivables or the collectibles from the customers. So these accounts will increase the assets of the business entity. And remember, debit what comes in. Okay, so we go to the expense account. So expense are considered as reduction to the equity of the owners. So according to the second rule, debit all expense and losses. Example of expenses are rent expense and salary expense, because this will reduce the equity of the owner. So it will be on the debit side. And then we go to the dividend accounts. Okay, so dividends are the income distributed to stockholders. So these are the income. So it can be in the form of cash, stocks, or property. And according to the third rule of debit and credits, debit the receiver. Okay, so who are the receivers of the dividends? The stockholders. Okay, so remember, increase in assets are recorded as debit. Expenses are considered as reduction to the equity of the owners. So it means, according to Rule 2, debit all expense and losses. And the third rule is debit the receiver. Okay, so we're done with the debit side. So we go to the credit side. Okay, so according to rule number 1, credit what goes out. Okay, so what does it mean? Okay, so decrease in assets are recorded as credit. Okay, so example, the cash outflows of the business entity. Okay, example like paying the obligations to the creditors in cash. And then another example, the purchase of new equipment in cash. Okay, so and the payments of the salaries of the employees. So those are the outflows of assets in the form of cash. So decrease in assets are recorded as credit. Okay. So the normal balance of the asset, expense, and dividend accounts is debit. Okay, so remember the normal balance of assets, expense, and dividend accounts is debit. Now we go to the liabilities, equity, and revenue accounts. So these accounts, which position in accounting entry we are going to identify with. Now we go to the liability accounts. Okay, so any increases in liabilities are recorded as credit. Okay, like example, the business entity purchased a new vehicle to be used for daily operations on account or credit to a certain creditor. So it means the business entity has an account payable to the creditor or an obligation to pay. Okay, so another example of liability, increase in liabilities, is the unearned revenues. Example of unearned revenue is the business entity already received the advanced payment for the service that has not yet been served. So it means the business entity has an obligation to do a service, and this increases the liabilities of the business and it will be credited. Okay, so we go to the equity account. Okay, so any increase in equity accounts are recorded as credit. Okay, so example of equity accounts are the capital account and the common stock. Okay, so according to rule number 3, debit the receiver, credit the giver. So the giver on this time is the owner of the business entity. Okay, like the business owner decide to invest, okay, or add additional capital to the business. Now we go to the revenue. Okay, or revenue. So increase in revenues are recorded as credit. Okay, so according to rule number 2, debit all expense and losses, credit all incomes or revenues and gains. So what are revenues? So revenues are the amounts received by a business earned as a result of selling something or rendering a service. So revenues are the increase in equity as a result of day-to-day operations. So example of revenues are the sales revenues or the fees earned. Okay, so any increase in liabilities, any increase in equity, any increase in revenues are recorded as credit. Okay, so we go to the debit side of the accounting entry. Okay, so decreases in liabilities are recorded as debit. Okay, example, the business entity paid the obligation to the creditor. So it means there will be a reduction of the owner's liability. So the business entity already paid his or their account. Okay, so it will be recorded as debit. And then decrease in equity are recorded as debit. So example, the personal drawings of the business owner. So and that action, like the drawings, will reduce the equity of the owner. So it will be recorded as debit. Okay, so decreases in liabilities and decreases in equity accounts are recorded as debit. And the normal balance of liabilities, equities, and revenue accounts is credit. Okay, so remember that, guys. Increased in liabilities, increased in equities, increase in revenues, it will be recorded as credit. And decreased in liabilities, decreased in equities, it will be recorded as debit. And then the normal balance is credit. Okay, so I have here a summary, okay, so for you to remember. Okay, so rules for asset accounts. An asset account is increased on the debit side. An asset account is decreased on the credit side. And then the normal balance for an asset account is a debit balance. Okay, so rules for liabilities and owner accounts. Okay, so the liability and capital accounts are increased on the credit side. The liability and capital accounts are decreased on the debit side. The normal balance for the liability and capital accounts is a credit balance. I have here an illustration, guys, for us to practice. So the first transaction says the proprietor contributes some cash to the business. So what will be the debit and the credit? So the debit will be the cash account because it increases the assets of the business entity. And then the credit will be the capital account of the business entity. So any increases in equity will be credited. Then we go to the second transaction. A van is purchased for use in the business. It is paid by check. So what will be the debit and the credit? So the van or the vehicle will be debited to the owner, business entity, because this is an increase to the assets of the business entity. And then the account that will be credited will be the cash accounts or cash equivalents, because it was used in purchasing the van. And then we proceed to transaction 3. Some goods are purchased for cash. So what will be the debit and the credits? So goods represents the inventories of the business entity. So in order for the business entity to have sales, so they need to purchase goods that will be used for service or merchandising purposes. Okay, so the debit will be the inventory account because it increased the assets of the business entity. And then the credit will be the cash account. Okay, so the cash was used in purchasing the goods. Okay, so we proceed to transaction number 4. Some goods are purchased on credit terms from Fred. Okay, so we have goods. Okay, so debit the inventory account, and then the transaction says that instead of cash, so it was purchased on credit terms from the creditor. So the account title will be the account payable. So according to the rules of debit and credit, increased liability will be credited. Okay, so account payable is credited. Okay, so we go to transaction number 5. Some goods are sold for cash. Okay, so the business entity now earns sales from the selling of merchandise. Okay, so what will be the debit and the credit? Okay, so the business entity received cash. Okay, so the cash flows to the business. Okay, so the debit will be the cash account. And then, according to the rule of debits and credits, increased income will be credited. Okay, so income or sales account increases the equity of the owners. So it is credited, the sales account. Okay, and the last transactions say some cash in the till is paid into the business bank account. So what accounts are affected by these transactions? Okay, so it shows cash and then bank account. So the debit will be the bank account because the money were put into the bank, and then the credit will be the cash accounts. So actually only the asset accounts are affected by these transactions. So increase assets and then at the same time decrease assets. So liabilities and equity accounts are not affected. Okay, so let's have a quiz. Determine what accounts are debited and credited. A. Cash sales. B. Rent paid by check. C. Wages paid in cash. D. A supplier of goods paid by check. E. Goods sold on credit to Ford. Thank you for watching our videos, guys, and don't forget to follow our tutorial videos. Click like and subscribe. Well done.